Hi, Sean Hathaway. Going to give you a quick update on how the corona crisis is affecting the economy and the stock market. Well, one, it's a global pandemic, and we're seeing unprecedented volatility in stocks. We saw the fastest drop ever in the US stock market. In 22 days, it dropped 30%. We also saw the largest one-day gain of 11% in almost 100 years. And it's not over. We still have a lot of uncertainty in front of us. Overall, just some broad indicators here. Bonds are down about 10% year to date. They were down about 15%. The US stock market's down about 30% year to date. It was down around 35%. We also looked at sectors in the market. There's 11 sectors. Consumer and healthcare are holding up okay. They're only down about 17%. Energy is down about 46%. Drilling in a little deeper here into kind of the travel and somewhat of the leisure space, air, land, and sea, all down anywhere from 50 to 80%. Real quick, gross domestic product. A lot of times we'll talk about going into recession or depression. When we talk about a recession, that really represents a decrease in gross domestic product quarter over quarter. You can think of that as the sum total of everything that we spend. You, me, all of us as consumers plus government spending. The total is about $22 trillion a year. That helps put some perspective around the government, which is putting in $2 trillion to help the economy. So adding about 10% to what we normally see. This week we have, over the last 2 weeks, 10 million people have applied for unemployment. This is a really important data point because it has ramifications throughout the entire economy and the stock market. To put this in perspective, that represents, these 10 million people over the last 2 weeks represent about 6% of the US workforce. Also, to put in perspective, during the 2008 financial crisis, the 1 week largest weekly claims was 670,000. We had 10 million in the last 2 weeks. So what happens here? What does this even mean? So first off, keep in mind, these 10 million people, they're not the salaried folks working from home on Zoom in their cozy kitchen. They were the people with largely hourly workforce that have been pushed out of employment, largely living previously from paycheck to paycheck. So now the first thing that's going to happen is they're not going to be paying their rent or their bills. You may have what we've heard, some rent holidays or vacations being put in place by certain states, not allowed to evict. That doesn't mean they're not going to back bill you though. Maybe you don't pay rent for a month or two, but you still owe it. So what's going to happen here is credit records are going to be destroyed. This is going to have carry-on effects. How are you going to purchase cars in the future or durable goods, etc.? Use a credit card if you don't have a good credit score. Other examples of how this affects the economic dominoes, I call it. You can think about the air industry, for example. So about 70% of flights have been canceled. So Boeing stops building airplanes. That puts 10,000 suppliers basically out of business, or a significant part of their business is gone. More people out of work. Again, rent's not being paid. Airport workers out of work. Airport stores aren't paying their rents. This cascades through commercial real estate and on up to financials and institutions. And I'll show you how that affects you and me in a second. Here's another one. I like to just drive home how this plays out through the economy. So here's what I call a chain reaction. So we've read about and heard about Cheesecake Factory, Gap, and Macy's furloughing hundreds of thousands of workers. We talked about how all those workers, obviously, they're not going to have a paycheck, their credit's going to be destroyed, and they can't pay their rent or their bills. And those stores now are not going to pay rent. Well, who do they pay rent to? Like, who owns these shopping, these malls? Well, one of them, one large holder is called Simon Property Group that many of us have probably never heard of, which is fine. But keep in mind, they are an S&P 500 stock, so it's a very big company. And I'm going to get a little financial tech nerdy here, but it's important to understand their capital structure. So their assets are all these malls and properties they own, but how do they finance all of that? Well, they finance it two ways. One is through raising equity through stock. So you might own their stock, and so you finance them that way. And then they also raise debt. So they have $17 billion of equity and $24 billion of debt. And so at the end of the day, who owns all that? Well, guess what? If you have a 401k, I can almost guarantee you that you own Simon Property Group because they're in the S&P 500. So they're owned by mutual funds, people that own stocks, pension holders, and 401ks. Same with bonds. When you hear about diversified portfolio, you should own bonds and stock. Well, guess what? If you're holding bonds, you might very well be holding Simon Property Group because they have $24 billion in bonds outstanding. So again, that goes into the pensions, 401ks, comes right back to everyone else. So this actually, you might say, oh, it's just affecting the financials and the banks, but it actually rolls right back to everybody, you and me. This is just kind of the financials here, kind of looking at the four lines. You can see Simon, Cheesecake, Macy's, and Gap, basically all equity down anywhere from 60 to 75%. So what are we going to do? Well, there's a couple of, clearly we need to figure out how to contain and kill the virus. But there's another school of thought as well that's starting to emerge, or at least get some more press, and that is how do we not kill the economy? Because that's already happening. So right now we've got a lot of blanket social distancing going on. You know, how do we maybe make that a little bit more targeted social distancing? Right now we've got a lot of orders in place in various states closing all non-essential businesses. Well, maybe how can we actually get some of people back to work? We'll have to figure this out, and we will. We'll figure it out. Signs that we will figure it out and get back to normal. We can look to China for a little bit of hope and some green shoots. Look, we can't trust the data in China. They have most certainly understated their number of cases and number of deaths. But there are some things we can trust. So FedEx, who ships in and out of China, has reported they think about 90% of Chinese factories are open. And some big American brand retailers have reported all of their stores being open. Lululemon, Starbucks, Apple, Nike. So that's good. And keep in mind, though, China is still mitigating this. You know, they still are banning large crowds and gatherings, and their movie theaters, for example, are not open. You know, most people, at least, think that the economy should snap back relatively quickly. This being a health crisis as opposed to a financial crisis, so there's really no underlying structural fundamental issues with the economy. However, the longer we're down, the harder it's going to be to snap back up. And that's because of things I previously mentioned, credit reports being destroyed. It's going to take longer for people. They may not want to hire people back quite as fast. So it's actually going to take a little bit. So we'll see there. So remember, now we'll go into the stocks a little bit here. Bull markets always follow bear markets, and they always follow bear markets in a big way up, and usually it's bigger. In this crisis, there's two types of companies. That's it. There's the companies that need help and are going to go bankrupt, and there's the companies that won't. Avoid the first. So, avoid companies that may need help or even are at risk of bankruptcy. Remember the ones we already just talked about, air, land, and sea? Go ahead and add on to that restaurants, retail, especially the mall-dependent retailers. So as an example, Nike and Lululemon are both actually doing okay, but they're not dependent on malls. They have good online presence. Movie theaters, don't go near them. Oil and gas, also dangerous. Automotive, financials, big question marks there. Depends how long this lasts. It could destroy both those markets as well. So what should you buy? Well, I kind of break it down into two buckets. One is the unfairly beat down, I call them. So these are strong companies with strong balance sheets that have been dragged down by the just overall market that are going to bounce back and rally after this. And second is kind of these companies that are being caught in the secular trend. So what are these secular trends? You know, crises and recessions accelerate these trends. So some of these trends like working from home, you know, cutting the cord, streaming TV from home. That could be TV, movies, video games. And then also just sanitation, you know, being clean. So some of the companies these aren't recommendations, these are just some kind of obvious ones I think that are unfairly beaten down. Microsoft, Nike, Apple, Alphabet, Disney, Lululemon, they're all down anywhere from 20 to 30+%, and they all have strong fundamental businesses. I don't see any reason why they won't come back to previous levels. And then kind of the secular trends like we talked about, the streaming, so Netflix, Roku, good streaming plays, Amazon also, and Amazon has the delivery element, kind of the stay-at-home shopping secular trend. And then working from home, so you've got your Ring Central and your Zooms that do your video conferencing from home. That concludes my presentation. If you have any questions, feel free to email me direct, or shoot me a message on Twitter. Please practice social distancing. Let's figure out how to get back to work and stay healthy and positive.